Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Steve St. Angelo from the SRSRoccoReport. Steve, thank you so much for joining us today.
Well, hello, Elijah. Yes, there's a lot going on in the market, so we've got plenty to talk about. Great to be here.
Definitely, and I was really interested in your recent article you wrote, The Blind Conspiracy. You talk about basically a lot about gold and silver manipulation and how also the other markets, for example, the stock market, is being manipulated. And you talk about something you call the blind conspiracy and how there's this fundamental change coming for the gold market. Can you expand on what this blind conspiracy you speak of is?
Yes, well, there's the major, let's say, theory by the precious metal analysts and the alternative media community is that the majority of the price of gold and silver has been manipulated by the Fed and central banks, as well as the bullion banks. And I agree that is going on, but that seems to be the only reason. What I call the blind conspiracy is energy runs the whole system. And what's amazing, the whole energy system, especially the oil industry, which actually is the lifeblood, not electricity. The whole world runs on oil. Without oil, the whole just-in-time inventory system collapses. So the oil is the most important. And now the oil industry is in really bad shape. But unfortunately, it seems like the energy analysts don't see it. It doesn't seem like the mainstream media doesn't see it. Even the alternative media, a lot of the analysts don't see it. So it's kind of a blind conspiracy. We're heading toward a future that we're not prepared. And from the evidence I'm seeing, the oil markets, the oil industry is really disintegrating. I call it's being cannibalized just to stay alive. So the three big areas that the market is invested in, Elijah, are stocks, bonds, and real estate. And the value of most stocks, most bonds, and even real estate are based upon the economic principle of net present value. So you have to burn energy in the future to be able to justify the value today. The difference between gold and silver, their values came from burning energy in the past. Because when you've got a gold, silver, or gold eagle in your pocket, all the economic energy that went to make that gold coin is already in there. It's kind of like it's a stored economic energy. So this blind conspiracy I'm talking about, the market doesn't realize that we're heading towards a crash, a collapse. And so when that occurs, the valuations of most stocks, bonds, and real estate are going to plummet. And so I wanted to start with that because I don't even think most of the alternative analysts out there, media analysts, like let's say like Peter Schiff, and I'm not just calling him out, but a lot of these guys think that if the banks go under, if we start a new economic system based upon the gold standard, then everything's going to be fine. Well, it won't be. We just don't have the good quality, cheap energy anymore to run our system.
Now, that's really interesting how you were talking about how stocks, bonds, and real estate get their value from burning energy in the future, but gold and silver bought today, they get their value from burning energy in the past. Can you kind of expand on that? Because basically you're saying if there's this energy crisis, stocks, bonds, and real estate will really get hit hard, but gold and silver won't. Is that your point?
Yes, matter of fact, gold and silver the values will increase because The Fed and central banks have, I actually call it, they've bamboozled. They've hoodwinked the market into funneling their funds into stocks, bonds, and real estate and away from precious metals, gold and silver. Now, the reason why this works this way, you have to think about what is a Federal Reserve note. It's a note. A note is something you owe. If you owe somebody something, you've got to do something to pay them back. Whether it's you provide labor, you sell something of yours, you get the money and you pay them back. Well, a stock behaves that way. A stock is no longer based upon, like in the 1920s and 30s, book value. You sell the company and then that's what it was worth. Today, the stock prices are based upon earnings, and they're multiples of earnings. Like Caterpillar. Caterpillar is their price to earnings now is like 98, where their average is 16. This is completely insane. So those earnings are based upon future sales of Caterpillar in the future. So if you have the energy to continue the business as usual, then that works. But if the energy becomes really problematic, Elijah, and we start seeing cliff-like declines in oil production, then all those valuations are destroyed. Now, the difference between a gold coin that you have in your pocket, somebody else has to do some kind of labor, work, or provide you with a good. They've got to do something. You've got it stored. That's much different than a stock, bond, or real estate, because if you think of a home, most homes are owned by a mortgage. So you have to continue to go to work. We have to continue to burn energy to go to work to create economic activity so you can pay your mortgage off. Well, if we have a big crash in the markets and people lose their jobs, then people aren't paying their mortgages. The whole real estate prices collapse. So this is how I look at the difference between stocks, bonds, and real estate, besides gold and silver.
Now, getting more into the gold and silver markets, another piece you recently wrote was about silver manipulation and what a lot of analysts right now aren't actually looking at with respect to the manipulation in the silver market. Can you expand on this?
Some analysts say that the Fed and central banks can push the price of gold and silver anywhere they want. I disagree with that. And the reason why I disagree with that, Elijah, my research, I no longer believe in supply and demand as the ultimate determining factor of price. Supply and demand factors do impact the price of metals, energy, goods, and services on a short-term basis. They will. If there's a big flood and it wipes out all the corn crop, yes, the price of corn is going to spike. But if we look at the price of metals like gold and silver, the market price of gold and silver has been based upon the cost of production, because I can guarantee you there aren't any primary silver miners out there producing silver at $5 an ounce and making an $11 profit. And there aren't any silver producers out there producing silver at $35 an ounce and almost losing $20 an ounce, as a loss. Now, some, they go by cash costs, but that's a bogus metric. That doesn't even include all the costs. It's a fraction of the costs. So if we understand that, then there is a floor where the price of silver or gold can go, and it's its cost of production. And so I also look at the whole market that way. No one is selling tennis shoes for 4 or 5 times what they cost to produce them. I'm talking by the time it gets to the store, it's inside the store. The whole chain from extracting the materials to produce the shoes, to manufacture the shoes, to transport the shoes, and then get them in a store. When you add all that up, there's a small margin that shoe store is going to get for that shoe. No one is selling shoes at 2 or 3 times their price. So when we understand the whole market is based upon a cost of production, then there is some method to the madness. The central banks realize they cannot push the price of silver too far below its cost of production, as well as gold. And I'll tell you right now, even though the price of silver has fallen to about 16, a little bit below 16, Elijah, from what I've been seeing, the primary silver miners, their break even is between 15, 16, and 17. Some are 15. Some are a little bit higher. Core is losing money, and Pan America is probably just about breaking even now. They're probably maybe losing a little bit of money. So I don't see the price of silver going to $5. It would wipe out the majority of the primary silver mining industry. And that's how I see it a little bit different. But we can get into why the cost of producing gold and silver should not be the basis of their price. That's a whole different discussion.
Right. So then where would the floor be for the silver price?
Well, the floor would be right about here. It could go into the 15s. It has, but actually in that article I show Pan American Silver. Now, Pan American 2004, when the price of silver was $6.67 an ounce, Elijah, they lost 10 cents. But as the price increased to 2011, they were actually making a little bit of money. And in 2011, when the price of silver was 35, their net profit was $9. Now, as the price of silver fell, they were losing money in 2013, 14, and 15, but it was between 40 cents and $1 an ounce. That's not going to break them. And in 2016, they actually made about $1.50. And so what we are seeing here is the floor of the price of silver would probably be around the primary silver miners' cost of production, because they do supply 30% of the silver. So again, but that is what it costs to produce silver. We have to remember gold and silver are the few commodities that aren't really consumed. Silver is consumed more in industry, but gold is saved. Most of it is saved, and silver to a lesser extent is saved. So it's much different than corn or copper or oil or natural gas. These are all consumed. So gold and silver should be valued differently because they are stores of economic energy and money. And so I see the values of gold and silver really skyrocketing when the markets really crash, and it brings down oil production, because people are going to realize they're in assets they're going to be stuck in assets like real estate they can't sell, stocks that will continue to fall in value, and bonds that are going to be in big trouble. So why would you want to be in those three assets?
No, you also wrote an article recently about, you're talking about how basically in the future that you think demand for gold and silver will skyrocket. But actually right now, investment demand for silver, you say, is being misreported. Can you expand on this?
Yeah, let me clarify that. There's two major analyst groups out there, industry analysts. One is a CPM group by Jeff Christian, and the other is Thomas Reuter's GFMS. And CPM group puts out the Silver Yearbook, Gold Yearbook, and the GFMS for the World Gold Council and the Silver Institute put out the World Silver Survey and the World Gold Survey. GFMS looks and includes investment demand in their analysis. However, the CPM group, and they were at the San Francisco Gold and Silver Summit, Jeff Christian said that that industry analysts that have been using investment demand are simply wrong, because why is the price of silver not increasing if there's all this investment demand? But what they do at the CPM group, they look at total fabrication compared to supply. Now, fabrication is, industrial demand, it's jewelry demand, it's photography demand, and it's there's one more, I can't think of it, but like photovoltaic. So when you add all those up, that's what they look at. They just look at fabrication, what the market is consuming. Basically, CPM Group totally omits silver investment demand as a factor in anything, not just price, but as in the overall supply and demand fundamentals. Now, what Jeff goes on to say is that if you just go by the fabrication demand and the supply, the price matches up perfectly. Well, I looked at his chart, and he stated that there were deficits from 1990 to 2005. There were deficits every year. Well, you know what? The average price of silver for that 15-year period was $5.05 an ounce, about $5. Well, when it start going into surpluses in 2006 to today, the average price is 19 and a half. Now, why would there be a surplus? Why would the price quadruple to almost $20 when there's been surpluses? And according to their analysis at the CPM Group, there's been almost 900 million ounces of surplus over those since 2006. So to me, when there's surplus, that means the price should fall. Yes, investors are buying it, but when there's deficits, that means the price should increase. But according to their work, it's not. Now, the difference is when you look at GFMS, they include investment demand. And they've been seeing actual deficits for the last several decades. Now, this year, they say we're going to have a surplus because investment demand has fallen. Now, what has been used to fill in the holes of this deficits has been 100 years worth of old official silver coinage that has been remelted, and it's been in different vaults around the world. And so that has been sold into the market and been used to supplement. And we're running out of that. But I'll conclude by saying there's approximately 2.5 billion ounces of above ground silver. Most of it is investment silver. And let's say 1 billion of it is official coins like silver eagles and Canadian maples. No one is selling those in the market, having them remelted, and then using them for electronic parts. No one's doing that. Anybody who sells silver eagles, the dealer resells them to somebody else. So that fabrication of silver is not going back into the market and remelted. Maybe some old bars are. So I look at what has been invested in silver. It's actually in very tight hands, and very little bit will go into the market. Some will, but very little compared to what we've seen in the past.
So where do you see this going from here? I mean, can you expand on what you see investment or silver demand in the future being?
If we look, here's a good gauge. Like for gold, I look at what's happening in the gold ETFs. I don't care if the gold is there. I don't get into that debate whether the gold ETFs like the GLD have their gold. What I look at is the huge price spikes. There have been two huge spikes in gold ETF demand. One in 2009 when the markets were falling to their lows, when the Dow Jones was hitting 6,600 and Jim Cramer was on CNBC calling for the end of the world. We had like 450 metric tons of gold demand by retail investors, the public. Now that we haven't seen that ever before. Now the only other time, Elijah, we saw something that high was the first quarter of last year, 2016. It was like 350 metric tons of gold demand. And you know what that was from? From a 2,000 point drop in the Dow Jones. Investors were scared. And so if they were scared on a 2,000 point drop in the Dow Jones at 350 metric tons of supposed demand flowing into the gold ETFs, what's going to happen when this market finally crashes, that it's so over leveraged? And I'll say this too. 2008 was the demarcation. That was when the financial industry died, really did. And it's been propped up. Now, from 2000 to 2007, investors purchased about 11.5 metric tons of silver investment. From 2008 to 2015, same period, same 8-year period, it almost quadrupled to 44,200 tons. So even though investment demand has declined this year because we had Donald Trump in the White House, people think, well, maybe he'll fix things. Well, he's not, but that's what the idea was, as well as this crazy crypto market. And so it's taken away from the silver market. But still, gold demand is still 40% of the market today. Physical investment, total gold demand is 40% of the gold market. And in 2002, it was 10%. Almost the same thing with silver. So silver is still a much larger percentage of their overall market. And even though it's fallen this year, when the markets crash, Elijah, my answer to you is I see huge increase in demand, huge increase in demand. And that's when we'll start seeing some crazy silver and gold prices.
All right. Well, Steve St. Angelo, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yes, I put out 2 or 3 articles a week at the SRSRoccoReport. I will be actually starting a YouTube, doing my own YouTube videos, and I don't know why I didn't do it before, because it's an excellent medium to explain some of these concepts on video visually. So please check out for my SRSRoccoReport YouTube channel, and I will be putting out some new videos. And look, maybe we should check back again in the next 3-4 months, because Elijah, I do think we're going to see a crash in the crypto market. There's reasons for that. It's not just a gut feeling, but there are a lot of things going on that if some of these trading activity that was done in the stock market that's happening in the crypto market, people would be going to jail for 15 years. So there's a lot of craziness, a lot of insanity. I'm not against cryptos. I think it's a very interesting thing, but what's happening now in the market, it's really insane. So hopefully we can touch base again in 3-4 months.
Definitely. And if you wanted to briefly expand on that, because I know you're talking about the stock market being in a bubble and you see a crash coming, but with Bitcoin, for example, it's just skyrocketed in this year. You know, now it keeps getting to all-time highs. Last week it just went above $10,000 a Bitcoin. Now it's, you know, almost 12,000 or something. I can't keep track of this, but I guess, can you expand on the reasons why you see Bitcoin and maybe other cryptocurrencies crashing soon?
Okay. The Bitcoin actually hit 12,800 today. And if you look at a Bitcoin chart and you give it to any math teacher, he'll tell you, oh, that's the exponential chart. Exponential means it starts off horizontal, it starts going up 45 degrees, and then it ends up straight up. Nothing continues that way. Nothing does. It just doesn't. So just looking at that chart, it has to correct, because it just can't keep going straight up. It's actually like straight up. So that's problem number one. Problem number two is, I have been hearing in the grapevine that if you want to sell a substantial amount of Bitcoin, you can't do it. First of all, if you try to sell over, let's say, 50 to 70,000, which isn't many Bitcoin, it might be 6 or 8 or 10 Bitcoin, you're having trouble getting funds. You can sell them, but you're not getting the funds into your bank account. That's a red flag. Number two, other exchanges like Coinbase, which I've used, you can't sell any more than 15,000 in a week. Well, at 12,000 Bitcoin, if you purchased a lot of Bitcoin when you were lucky years ago and you want to try to sell some, you get to sell one a week. So I think the issue with the Bitcoin market, with the huge market cap now of Bitcoin, it's all leverage. I don't think there's a lot of cash to back it up. And with this idea that a lot of you can only sell so much a week, or they're limiting you what you can actually sell and get cash for, that to me signals a red flag. Another thing, there's been some very interesting trading activity, and we've been even approached by our token that if this sort of activity was done on the stock market, and yes, I know there's fraud in the stock market, but if you were caught doing this sort of activity, front running and paying a company paying to get their tokens or their cryptos to be traded, you go to jail. Well, in the cryptos market, that's not the case. It's like it's a Wild West squared. And so when you look at this information, just look at something is a lot of fraud everywhere. I see a lot of fraud, and there's other aspects I don't want to get into, but I'm not against the cryptocurrency blockchain technology, but I think a lot of money is going into it, and I think it's a lot of leverage. So when it finally sells off, there's not really anything there. And lastly, the CME group is going to allow Bitcoin to start being shorted on December 18th. Right now, Bitcoin and the cryptos aren't being shorted like gold and silver are, or most other stocks and commodities. Well, what is that going to do to the market? So I don't know. I could be wrong. But looking at all these different things, Elijah, I think we're going to see a huge crash in the cryptocurrency market. So we'll see what happens over the next several months.
All right, definitely. We'll definitely have you back on in a couple months to see what has happened. Well, Steve St. Angelo, thank you once again for joining us. If people are interested in learning more, they can go to SRSRoccoReport.com. Once again, Steve, thank you so much for your time.
Thank you very much.